I just did something that shocked Wall Street. After holding Bank of America for over a decade, after accumulating one of my largest positions in the company, after publicly praising the management and the business model countless times, I sold, not a little bit, I sold billions of dollars worth of Bank of America stock. I reduced my position dramatically. And the financial media went crazy. They wanted to know why. They wanted to know what I was seeing that they weren't seeing. They wanted to know if this was a sign that I'm bearish on banks or bearish on the economy or bearish on America. Let me be very clear. I'm not bearish on America. I'm never bearish on America. Over the long term, America will prosper. The economy will grow. Businesses will thrive. But I'm also not stupid. I'm not sentimental. I don't hold stocks because I like the company or because I've held them for a long time. I hold stocks when they represent good value, when the price is attractive relative to the intrinsic value of the business. And when the price gets too high, when the valuation gets stretched, when better opportunities appear elsewhere, I sell. That's what I did with Bank of America. And I'm going to explain exactly why I sold it and what I'm buying instead. Let me start by explaining why I bought Bank of America in the first place. This goes back to 2011. The financial crisis had devastated the banking sector. Bank of America was in serious trouble. They had acquired Countrywide Financial, the subprime mortgage lender, right before the crisis. That acquisition turned into a disaster. Countrywide had made thousands of terrible loans. Bank of America was facing tens of billions of dollars in losses and legal settlements. The stock had crashed from $55 in 2007 to $5 in 2011. The company was on the verge of collapse. People thought they might need another government bailout. It was a mess, but I saw opportunity in that mess. I saw a bank with 100 million consumer relationships, with over 5,000 branches across the country, with a massive deposit base, with businesses that could generate enormous profits once they got past the crisis-related issues. The fundamental franchise was intact. The problems were real, but they were solvable. And the stock was trading at a massive discount to what I thought the business was worth. So in 2011, I invested $5 billion in Bank of America. I bought preferred stock that paid me a 6% dividend. And I got warrants to buy 700 million shares of common stock at around $7 per share. It was an incredible deal. Bank of America got the capital and credibility they needed. I got a great investment with significant upside and downside protection, and it worked out beautifully. Bank of America cleaned up their problems. They settled the Countrywide litigation. They paid off the government assistance they had received during the crisis. They strengthened their balance sheet. They improved their operations. They started generating strong profits, and the stock price recovered. It went from $5 to $10, then to $20, then to $30, then to $40. I exercised my warrants. I bought my 700 million shares at $7, and I held them as the stock continued to rise. But at the peak, my Bank of America position was worth over $40 billion. That's an 8-fold return on my $5 billion investment. It was one of my best investments of the past 15 years. The CEO, Brian Moynihan, did an excellent job turning the company around. He simplified the business. He improved efficiency. He strengthened risk management. He returned massive amounts of capital to shareholders through dividends and buybacks. Everything I hoped would happen, happened. Bank of America became a great bank again. So why did I sell? Why did I reduce a position that had worked so well? Why did I walk away from a management team I respect executing a strategy I believe in? 3 reasons: valuation, regulation, and better opportunities. Let's start with valuation. When I bought Bank of America in 2011, it was trading at about half of tangible book value. The stock price was $5, and the tangible book value per share was around $10. That's a huge discount. I was buying assets worth $10 for $5. Even if the bank never recovered, even if it just muddled through, I was getting a good deal. And if it did recover, which I believed it would, the upside was enormous. Today, Bank of America trades at around 1.3 times tangible book value. The stock is around $40 and tangible book value is around $30. That's not a huge premium, but it's not a discount either. It's about fair value, maybe slightly above fair value. And when a stock reaches fair value, when the price reflects the intrinsic worth of the business, the future returns come entirely from business growth. There's no valuation tailwind. You're just getting whatever earnings growth the bank delivers. And here's my concern about Bank of America's earnings growth. Can they grow earnings at 10% per year from here? Can they expand their net interest margin? Can they grow their loan book? Can they increase fee income? Can they improve efficiency further? Maybe. But it's going to be harder than it was over the past decade. The easy gains have been captured. The business has been optimized. And from here, growth is going to be more challenging. Banks make money in a few ways. They make money on net interest margin, the spread between what they pay on deposits and what they earn on loans. They make money on fees, things like investment management fees, transaction fees, credit card fees, and they make money on trading and capital markets activities. For Bank of America to grow earnings significantly from here, they need to grow in one or more of these areas. Net interest margin is under pressure. Interest rates have come down from their peaks. When rates were at 5%, banks were earning a lot on their loan portfolios while still paying relatively little on deposits. That spread was very profitable. But as the Fed cuts rates, as interest rates come down, that spread compresses. Banks earn less on their loans while still having to compete for deposits. Net interest margin declines. And that's a headwind to earnings growth. Loan growth is modest. The U.S. economy is growing at around 2 to 3%. Business loan demand is okay, but not spectacular. Consumer loan demand is moderate. Banks can't grow their loan books much faster than the overall economy grows. So if the economy is growing at 3%, banks might grow loans at 4 or 5%. That's decent, but it's not explosive growth. Fee income is competitive. Every bank wants more fee income. Everyone wants to be in wealth management. Everyone wants credit card fee income. Everyone wants investment banking fees. But this is a competitive business. It's hard to grow fee income at high rates unless you're taking market share from someone else. And Bank of America is already one of the largest banks. They already have significant market share. How much more can they really take? So when I look at Bank of America's growth prospects, I see a bank that's well run, that has a good franchise, that will generate solid returns. But I don't see explosive growth. I don't see earnings compounding at 15 or 20% per year. I see earnings growing at maybe 5 to 8% per year. And at one point, 3 times book value, that means the stock will probably generate returns of 7 to 10% per year going forward. That's not bad, but it's not great. And I can find better opportunities. The second reason I sold is regulation. Banks are highly regulated businesses. The government controls what they can do, how much capital they need to hold, how much they can pay in dividends, how much they can buy back in stock. And I'm seeing regulatory pressure increasing. The Biden administration has been tougher on banks than previous administrations. They proposed higher capital requirements. They pushed for more restrictions on fees. They've been more aggressive in enforcement. The Basel III endgame rules would require banks to hold significantly more capital. This reduces return on equity. It makes banks less profitable. It limits how much they can return to shareholders. These rules aren't finalized yet. The industry is fighting them. But the direction is clear. Regulators want banks to be safer, which means more capital, which means lower returns. There's also political risk. Politicians love to bash banks. They blame banks for economic problems. They threaten to break them up. They propose windfall profit taxes. Elizabeth Warren wants to break up the big banks. Bernie Sanders wants to tax bank profits. Even some Republicans have joined in with populist attacks on Wall Street. This creates uncertainty. It creates risk that banks will face new regulations or taxes that hurt profitability. I don't like investing in heavily regulated industries where the government can change the rules and destroy your returns. I made an exception for Bank of America in 2011 because the valuation was so attractive that even with regulatory risk, the risk reward was very favorable. But now that the stock trades at fair value, that regulatory risk matters more. I'm not willing to own a fair valued bank that faces increasing regulatory pressure, so I sold. The third reason I sold Bank of America is because I found better opportunities. This is the most important reason. I didn't sell just to raise cash. I didn't sell because I'm bearish. I sold because I found something I like better. Something I think will generate higher returns over the next 5 to 10 years. Something that has better growth prospects, less regulatory risk, and more attractive valuation. And that something is energy stocks, specifically oil and gas companies. I've been buying energy stocks aggressively over the past year. I now have one of my largest positions in Occidental Petroleum. I've been buying shares month after month. Berkshire Hathaway now owns over 28% of the company. I've invested over $15 billion. And I'm not done buying. If I could, I'd buy the entire company. I'd take it private. I think it's that attractive. And Occidental is just one example. I'm also investing in other energy companies. I'm positioning my portfolio for much higher oil prices over the next several years. Let me explain why energy is so attractive right now. First, valuations. Energy stocks are incredibly cheap, cheaper than I've seen in my entire career. The average oil and gas company trades at around 6 to 8 times earnings, 6 to 8 times. Bank of America trades at around 11 times earnings. The S&P 500 average is around 20 times. Technology stocks trade at 25 to 50 times. And energy companies, which generate massive free cash flow, which have real assets, which produce a commodity that the world desperately needs, trade at 6 to 8 times earnings. That's absurd. That's a gift. Why are energy stocks so cheap? Because everyone hates them. ESG investors won't touch them. Young investors think fossil fuels are evil. Financial advisors are scared to recommend them. Index funds are underweight. The sector has been left for dead. Everyone believes that oil demand is going to peak and decline, that electric vehicles will destroy gasoline demand, that solar and wind will replace fossil fuels, that these companies are dinosaurs with no future. And because everyone believes this, nobody wants to own energy stocks. And the valuations reflect this pessimism. But the pessimism is wrong. Oil demand is not declining. It's growing. Current global oil demand is around 102 million barrels per day. The International Energy Agency projects demand will reach 106 million barrels per day by 2030. That's growth of 4 million barrels per day. Where is this growth coming from? Emerging markets. India, China, Southeast Asia, Africa. These countries are industrializing. Their populations are getting wealthier. They're buying cars, they're flying on planes. They're consuming more energy. And most of that energy comes from oil. Yes, electric vehicles are growing, but they're still only 3% of global car sales. Even if EVs reach 20% of sales by 2030, that still means 80% of new cars have internal combustion engines. And the global vehicle fleet is growing. More people are buying cars. So even with rising EV penetration, total gasoline demand continues to grow. The math is simple. The world is not transitioning away from oil as fast as people think. And it's not just transportation. Oil is used to make plastics, chemicals, fertilizers, pharmaceuticals, synthetic fibers, asphalt, lubricants. These uses aren't going away. These uses are growing. Petrochemical demand for oil is growing faster than transportation demand. So even if transportation demand eventually peaks, which I don't think happens for at least another decade, petrochemical demand will keep growing. Total oil demand will remain strong for decades. On the supply side, there's massive underinvestment. For the past decade, energy companies have been told to stop investing in new production. ESG investors pressured them to return cash instead of drilling. Banks stopped financing new projects. Governments made permitting harder. Environmentalists blocked pipelines. The result is that we're not investing enough to maintain production, let alone grow it. Oil fields naturally decline. Existing wells produce less oil each year. You need to constantly invest in new production just to stay flat. The IEA estimates that global oil fields decline by about 3 to 4% per year. That means we need to add 3 to 4 million barrels per day of new production every year just to offset the decline. But we're not doing that. Investment has been too low for too long. This creates a supply deficit. Demand is growing by about 1 million barrels per day per year. Supply is declining by 3 to 4 million barrels per day per year from existing fields. So we need 4 to 5 million barrels per day of new production every year just to keep up. But we're only adding 2 to 3 million barrels per day of new production. There's a shortfall. And that shortfall is going to tighten the market. It's going to push oil prices higher. I believe oil is going to $100 per barrel, maybe $120, maybe higher. Right now it trades around $70 to $80. That's too cheap. It doesn't reflect the supply-demand fundamentals. When the market realizes how tight supply is, when inventories start declining, when OPEC can't produce more because they're at capacity, prices are going to spike. And when oil prices spike, energy stocks are going to explode higher. Let me give you some specific numbers on Occidental Petroleum to show you why I'm so excited about this investment. Occidental produces about 1.2 million barrels of oil equivalent per day. They have high-quality, low-cost assets in the Permian Basin in Texas. They also have carbon capture technology, which positions them well for a lower carbon future. They can both produce oil and capture carbon. That's unique positioning. At $70 oil, Occidental generates about $12 billion in annual revenue and about $2 billion in free cash flow. At $100 oil, they would generate about $16 billion in revenue and about $5 billion in free cash flow. That's 2.5 times more free cash flow from a 43% increase in oil prices. That's leverage. That's what makes oil companies so attractive. Their earnings are highly leveraged to oil prices. Occidental's market cap is around $55 billion. If they're generating $5 billion in free cash flow at $100 oil, that's a 9% free cash flow yield. And what are they doing with that cash flow? They're paying down debt. They're buying back stock. They're paying dividends. They're returning massive amounts of cash to shareholders. As they pay down debt, their free cash flow will increase even more because their interest expense will decline. Within 3 to 5 years, at $100 oil, Occidental could be generating $6 to $8 billion in annual free cash flow. That's a 12 to 15% free cash flow yield on the current market cap. Now compare that to Bank of America. Bank of America has a market cap of about $300 billion. They generate about $30 billion in annual net income. That's a 10% earnings yield, not bad. But it's not growing rapidly, and it faces regulatory risk. Occidental at $100 oil would have a higher cash flow yield and much faster growth. And the stock trades at a fraction of Bank of America's valuation. Occidental trades at about 7 times earnings. Bank of America trades at about 11 times earnings. Which would you rather own? A bank trading at 11 times earnings with modest growth prospects and increasing regulatory pressure? Or an oil company trading at 7 times earnings with explosive cash flow growth when oil prices rise and minimal regulatory risk? For me, the answer is obvious. I'd rather own Occidental. That's why I sold Bank of America and bought Occidental. But it's not just Occidental. The entire energy sector is attractive. ConocoPhillips, Chevron, Exxon, EOG Resources, Devon Energy, Pioneer Natural Resources. All of these companies are cheap. All of them generate massive free cash flow. All of them return huge amounts of cash to shareholders. All of them are positioned to benefit from higher oil prices. This is a sector-wide opportunity. This is not a single stock bet. This is a bet on oil prices and on the valuation re-rating of an entire sector. Here's what I think is going to happen over the next 3 to 5 years. Oil prices are going to move higher, back to $90, then $100, maybe $120 or more. As prices rise, energy company earnings are going to explode. Free cash flow is going to double or triple, and companies are going to return that cash to shareholders through massive dividends and buybacks. As this happens, as energy stocks start delivering these incredible returns, investors are going to notice. Fund managers who are underweight energy are going to be forced to add exposure because their performance is suffering. Individual investors are going to start buying because they see the returns. Financial advisors are going to overcome their ESG concerns because their clients are demanding performance. And this buying is going to push valuations higher. Energy stocks are going to go from 6 to 8 times earnings to 10 to 12 times earnings. That's a 50 to 75% increase in the multiple. Combined with earnings growth from higher oil prices, and you're looking at stocks that could double or triple from current levels, these are going to be some of the best performing stocks in the market over the next few years. And that opportunity, that is why I sold Bank of America and bought energy stocks. Now let me address the obvious objection. What about the energy transition? What about climate change? What about the push for renewable energy? Aren't you investing in a dying industry? These are fair questions. And here's my answer. The energy transition is real. It's happening, but it's happening much slower than people think, much slower than politicians promise, much slower than activists demand. The reality is that we're going to be using oil and gas for decades, not just 5 years, not just 10 years, decades, because we don't have realistic alternatives for most uses of oil. We don't have alternatives for aviation fuel. Planes can't run on batteries. They're too heavy. We don't have alternatives for shipping fuel. Container ships can't run on batteries. We don't have alternatives for petrochemicals. You can't make plastics without oil. We don't have alternatives for many industrial processes that require high heat. Electric vehicles will continue to grow. Solar and wind will continue to grow, but they're growing from small bases. And even with aggressive growth, fossil fuels will still provide the majority of global energy for at least another 20 to 30 years. That's the reality. That's what the data shows. That's what the International Energy Agency says. That's what even the most optimistic renewable energy advocates admit when they're being honest. So I'm not betting against the energy transition. I'm just recognizing that it's going to take much longer than people think. And in the meantime, we need oil and gas. We're going to use more oil and gas, not less. And the companies that produce it are going to make a lot of money, and their stocks are going to generate great returns. That's not a political statement. That's not an environmental statement. That's just math. That's just supply and demand. I've also thought carefully about the ESG concerns. I understand that some people don't want to invest in fossil fuels for moral or ethical reasons. I respect that. But I would point out that the companies I'm investing in are not evil. They're providing energy that billions of people need, energy that powers hospitals and schools and homes, energy that lifts people out of poverty, energy that enables modern life. Without oil and gas, billions of people would be in darkness and poverty. The companies I'm investing in are also leaders in emissions reduction and carbon capture. Occidental is building the world's largest direct air capture facility. They're removing carbon from the atmosphere. Chevron and Exxon are investing in carbon capture and storage. They're investing in renewable energy projects. They're reducing the carbon intensity of their operations. These companies are part of the solution, not just part of the problem. And here's the thing about ESG investing. When you refuse to invest in energy companies, when you divest from fossil fuels, you're not reducing oil demand. You're not shutting down oil production. You're just transferring ownership from public investors to private investors, from responsible companies to less responsible companies, from American companies to Saudi Aramco and Russian oil companies that have worse environmental standards. That doesn't help the environment. It just makes you feel good while accomplishing nothing. If you really care about climate change, the better approach is to own these companies and push them to reduce emissions, to engage with management, to vote your shares for climate initiatives, to reward companies that are leading on carbon capture and emissions reduction. That's constructive. That actually makes a difference. Divesting is just virtue signaling. So I'm comfortable with my investment in energy. I think it's the right decision financially. I think oil and gas will remain essential for decades. I think the companies I'm investing in are well managed and are making efforts to reduce their environmental impact. And I think the returns are going to be spectacular. Let me be clear about my overall view on portfolio allocation. I'm not saying everyone should sell all their bank stocks and go all in on energy. I'm saying that I found better opportunities in energy than in banks at current valuations. I'm saying that the risk reward in energy is more attractive than the risk reward in banks right now. Different investors will make different decisions based on their own analysis and risk tolerance. But I do think energy deserves serious consideration from any long-term investor right now. The valuations are compelling. The fundamentals are strong. The sector is hated and ignored. That's usually when the best opportunities appear. When everyone loves something and the valuations are stretched, that's when you should be cautious. When everyone hates something and the valuations are depressed, that's when you should be greedy. And right now, everyone hates energy. So I'm being greedy. I've been investing for over 70 years. I've seen multiple market cycles, multiple sectors go in and out of favor, multiple opportunities come and go. And one thing I've learned is that you make the most money by being contrarian, by buying what others are selling, by being greedy when others are fearful, by having the courage to go against the crowd. That's what I'm doing with energy. The crowd has abandoned this sector. They think it's a bad investment. They think it has no future. And that pessimism has created extraordinary value for those of us willing to look past the narrative and focus on the numbers. So that's why I sold Bank of America and bought energy stocks. Not because I hate Bank of America, not because I think banks are bad investments, but because I found something better, something cheaper, something with more upside, something that I believe will generate superior returns over the next 5 to 10 years. That's what I do. I allocate capital to the best opportunities available. And right now, the best opportunities are in energy. That's why I made this move. And that's why you should seriously consider following me into this sector, because this is where the value is. This is where the opportunity is. This is where the money is going to be made.